What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down options trading, what it is, the basics behind it, everything you know, just to kind of get started in options trading if you're looking at trading options. Again, this is not financial advice, so if you're excited for today's video, make sure that you like the video. Feel free to subscribe to the channel and turn on the bell notifications for all future uploads as per usual. You guys have been doing an amazing job supporting the channel, and thank you so much. I could not have been doing this without you, and I appreciate each and every single one of you. And as you will see, I really appreciate it because we are down almost 1% in the portfolio. Fun times. This market is absolutely wild. So what we're going to be looking at here is a couple things. Basically how options contracts work. If you're new to options investing, you want to get into options investing. Full disclosure, there is a lot more risk involved than just buying and owning shares of companies. Do not get me wrong. But if you're looking at getting into options strategies, options trading strategies, looking at anything that has to do with options, this video is for you. So we'll go into a couple tickers. We'll look at a couple different things and kind of analyze some charts. We'll pull up the options profit calculator so you can get more of an idea behind it. And again, as always, feel free to drop any questions you have down below in the comment section. At the time we're recording this video, the market is red. Great times. All right. So let's dive into this here, right? So again, I'm someone who's a big believer in SPY. As you will see, I do have 100 shares of the S&P 500. So this is what I like to trade a lot with. And I don't try to go aggressive with trading strategies here. I try to go as basic as possible. I'm not trying to break the bank and try to go super risky for super high reward. As you know, the more you risk, the more reward you get, but also the less likely you are to make money. SPY is currently down 1.06%. Great times to be alive right now for the markets. Markets are going through a lot of turmoils right now. Again, we have a lot of uncertainty in the markets here. So it's just hammered after hammered of just downside after downside here. So let's break down basically how this idea works. So say you are a new investor and you're saying, Fridge, I want to get into the S&P 500. And I say, that's great advice. Why? And the reason is, I want to get into the S&P 500. I want to own 100 shares of it, but Fridge, I don't have $56,000 here, because if you were to buy 100 shares of S&P 500 of SPY ticker right here, it's going to cost you $56,000, right? If you go into shares here, you go, hey, I want to buy 100 shares. Look at that whopping price. And a lot of us, myself included, I can't just sit there and say, well, I have $56,000 available for it. So instead of wanting to have exposure and owning 100 shares of the S&P 500, you can go into options instead, okay? Options basically has more leverage to it because you can own 100 shares without having to pay the full price for it. If you want to think about it, I guess the best analogy is imagine like real estate, right? When you're buying a house in real estate, you don't buy the whole thing up front. Usually you put a down payment down for it to have access to the house and then pay off as you go. It's kind of like that with stocks, where you're basically putting down some money to then own 100 shares of this ETF, for example, or any kind of stock that you have. Because obviously, as you know, I can't afford this, Fridge. I don't know what to do, but I want to have exposure to the U.S. economy. I want to be exposed to the markets. I want to invest in Apple, Amazon, Google, Facebook, you name it. I want it. Okay, so you're going to the options trading here. Now, what you will see with the options trading strategy here, and what's really cool, I think, about Robinhood and probably other portfolios and other brokerages as well, is that there is a builder that kind of breaks down how it works between buying a long call, long puts, covered calls, cash secured puts. There's a lot more things. This is more advanced. This is really advanced. This is even more advanced. We did videos actually on these two last time, so feel free to check that out as well on the YouTube channel. But we're going basics for now. We'll be focusing on just single leg options here, just to make your life more simple and simplistic, right? And you can pick what you want: bullish, bearish, sideways, whatever the case is. You could do it this way if you'd like to. It's kind of up to you. It's your choice. But what you will notice is a couple things here, okay? Up top, you have buy button and sell button. Up top, you have call and you have put. And you also have expiration dates, okay? Expiration dates are the one thing that's important because you're not going to be owning these shares for unlimited time periods. You're going to be having access to these 100 shares for a certain time period. And that's where the expiration date comes into play. You have access to the shares, but not for the entire time. All right. So that's the breakdown at the top here. Now, we have two ways we're looking at the options here, okay? We can buy options and we can sell options. The first part of this video, I'm going to be breaking down how to buy options and also talk about what in the money means versus out of the money and what's good and what's bad about it. Then we'll go into the selling options as well and kind of show you what I like to do because, again, I'm an option seller, not an option buyer. So if you're buying a call option, so say you want to say fridge by the end of this year, December 31st at the end of this year, I think I have my money. I want to put money where my mouth is and say, I bet the S&P 500 will rally and go up by the end of the year. But I can't take advantage of owning 100 shares of the S&P 500. I can only buy 2 shares or 3 shares. I don't have a lot of cash available. But instead, I want to have that exposure without having to put all that cash up there, right? So, okay, you're saying, all right, well, let's do this. The options chain here. So all these things here, all these different values here, these are all options contracts. And contracts are just like when you go to the store. Someone's a buyer, someone's the seller, right? The store manager is the seller. You, the consumer, would be the buyer, right? So you want to buy this contract here. So someone's buying it, someone's selling it. And the price that they have right here is the price that you agree to pay on, okay? So you agree to pay on this price here. You're agreeing saying, okay, I'm going to pay for this contract here. It's going to cost you this many dollars here. The seller says, okay. The seller collects the money. The buyer pays the money off. All right. So here's how this is going to work. So say you are sitting to yourself and saying, fridge, I've done so much due diligence. I've done so much research. I'm not on Wall Street bets. I'm not doing any of those gambling things. I've done my due diligence and research, and I am willing to bet that the S&P 500 will get to $580 by the end of the year. So about a $20 move up. Okay. This is contract that's available, and there's a lot of liquidity behind things. It's a whole different situation, but you're saying, fridge, I'm going to bet against you. I'm going to bet that the S&P 500 hits 580 by December. And I'm sitting here saying, no, dude, it's absolutely not going to happen. And you're sitting there saying, I'm going to put my money where my mouth is. I will bet you this amount of money. So what it basically says is, okay, you know what? Here, you have okay, let's make a bet and see what happens, right? So what this basically is you're telling me that you are going to be able to have access to 100 shares of SPY that are going to be at $580, okay? So you get access to these shares here, you get 100 shares worth, and this is what the contract's going to cost you, okay? Now, what the price is that you pay over here is how much you pay per share. So to have 1 share of SPY at 580, essentially, it's going to cost you $30. Now, with options trading, it obviously costs you 100 shares of that. So you take this value here, times it by 100, and that's where you see this max loss be calculated as a result. Because you're basically getting exposure to 100 shares at $580 each per share. And as we'll see here, we have a nice little calculation here, the nice little expected profits here, as you see. As the SPY ETF starts to creep up and creep up and creep up, you start to have this value. You start to get an increase in the value of this contract because it's becoming more and more likely. Options is a game of probability, right? It's a game of probability, so to speak. And as the price gets closer and closer and closer, you make more and more money because saying, hey, fridge, I'm getting very close to the strike here. And I'm like, oh no, I'm getting a little nervous here, right? So it becomes worth more value because it's more likely to happen. Just like if you were to bet in sports betting, for example, which people obviously do a lot of all over the place. When you do sports betting here, if you bet for something to happen, like you bet for LeBron James to score 1 point, you're paying a lot of money to get a very little payout because it's very likely to happen unless he doesn't play, obviously, right? Same thing's happening here. As you get closer and closer to that strike price, the option becomes worth more because it's more likely to happen. The probabilities start to go into your favor, all right? So that's what's happening here. Now, but before you sit there and say, well, fridge, I want it to be 580. Why is my break even at $611, fridge? That doesn't make any sense. I said 580. But here's the thing. You will break even when SPY hits $580, but you have to remember you paid almost $31 for the share. So taking your strike price here of 580 plus the price you pay, because that's part of your cost basis, gives you the break-even total of $611. 580 plus $31 gives you the $611. Now, after that, every amount that it climbs up, you start to get profit. And profit and profit and profit and profit. and so on and so on and so forth. And you're saying, well, Fridge, why do we get so much profit in this case? Well, because this is what could happen. When this goes to expiration, December 31st, 288 days away, you have two options. You can either exercise the contract and give yourself the 100 shares at 580 and say that SPY was trading at $600, right? Say December comes around and say, Fridge, I told you it was going to hit 580. It's actually at $600. The two options are the following. You can either exercise the contract. Exercise means that you will say, I'm going to buy the shares at that discounted price. Even though SPY is trading at $600, you, as the buyer, have every right to take your 100 shares of SPY at 580. And think about the profits behind that. $20 share price in the difference, right? So instead of being 580, it's 600. You got a $20 discount for 100 shares. You're basically already up $2,000 just for exercising that contract. And now you have 100 shares of SPY. Now, obviously, if you don't have $58,000 to pay for all those, you could also just sell the contract back and say, this is worthless, take it back, you can keep your shares, I'm going to keep the profits, and you can close the contract and keep the profits. So that's how you exercise versus selling it off. As you bought it, you also have the right to sell it whenever you want. If it goes against you, you can sell it. If it goes with you and goes for you, you can sell for a profit. Okay, that's what's kind of happening here. And again, as SPY keeps going higher and higher and higher, your max profit is unlimited because SPY can go to $1 million, which would be absolutely crazy, which will never happen. But your max profit is technically unlimited. And what you'll notice here is that your max loss is $3,076. That's because, again, that's basically about what you're paying for this price here. The max you will lose is $3,000. But again, think about the bigger picture. You are paying $3,000 to have access to $58,000 worth of the S&P 500 of SPY. Now, obviously, you only have it for a limited time, but it gives you leverage, and that's what options trading is all about, is it gives you that leverage. So if you buy this contract here, you're hoping that SPY gets to 580, but you actually want it to be closer to 611 because you got to factor in how much you pay per share. And anything after that break-even price is money, baby. You're making money, 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 money. You can exercise it off. You can sell it off if you want to, and you can collect those profits as you go. Now, if SPY goes against you, this contract becomes worth less because, as you know, it's less likely to happen. The less probability, the less it's worth, right? So say it comes in tomorrow morning and the market goes down even more, this might be worth maybe $2,800, for example, right? Like, for example, this one is already down $3.36 per share. So this contract alone right here has lost $300 in value for the 100 shares just today alone. So there's risk, right? And again, if you're willing to risk to lose $3,000, great. You can take that risk. You can gamble it. It's not a gamble really as much, but options can have a lot of risk behind it. So you're risking $3,000 to hopefully make more. So that's how buying call options works. Okay, buying a call means you're expecting that SPY to go higher. And on the opposite side, you can also buy a put option instead, which means you're betting for the S&P 500 to go down for the year. Fridge, I think the SPY is going to be down at 575 by, let's go lower than that because it's already at 560. Let's go way out of the money. Let's go 550. You might hear the terms in the money versus out of the money. For put options, this is out of the money because it's right now 560 and you're betting for it to go lower. Out of the money for calls, so you're betting for it to go higher than where it's at. So you're saying, Fridge, I'm going to bet that SPY is going to go down to 550. You want to take me on that bet? I say, absolutely. You're going to pay me $26 per share. And again, as someone who has 100 shares of S&P 500, I'm saying, you know what? That's fine. I'm willing to take that on for you. I will put my shares up against yours. But that's kind of the idea here. You're basically betting that the SPY will go down to 550. And again, as you will see, it's not 550, it's 523 as your break even because you got to factor in how much you're paying for each contract, or each share, I should say. Each share is going to cost you $26. So as someone who's the seller, which is me, because I have 100 shares of SPY, as someone who's selling it, I'm going to give you access to my 100 shares, but each share will cost you $26. $26 times 100 gives you $2,600. Okay. Now, as you'll see, as SPY goes lower, 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 say, Fridge, I told you. See, I told you to go to 550. I told you. You're making money as you go. But as long as it doesn't hit the 550, as you will notice here, I'm saying, well, you lost all your money. I get to keep all the money and I get my shares. All right. Now, here's the interesting thing also with buying a put, right? When you're buying a put, you have exercising and you also have selling as well. If SPY goes down to $540, way down here, and again, you wanted 550, exercising means that you are selling off the shares that you got from me for 550 to somebody else who's selling it for 540, right? So you're basically collecting the difference in that one if you exercise it, saying here's 100 shares. Okay, it's down at 540. Well, you promised you'd buy them at this price, so here you go. I'm going to buy them at this price. So you are being forced to buy at a higher value instead if you exercise it in that case. So let me reword it again, because I feel like it might be a little bit confusing. As someone who's buying the put option, right, you have access to 100 shares, but you're having access to 100 shares at $550, okay? If it goes down to 540, which is right here, you could still tell the person who you bought this contract from, you made a bet with me that it won't go to 550. It's below 550. I'm going to make you buy my shares at 550. That sucks for the buyer because now, even if it's 540 is what it's trading at, you're paying 550. You're paying $10 more per share times 100 shares is $1,000. So exercising put options is a way of basically saying, here, even though it's trading lower, you have to buy my shares at this price. That's what the put buyer is doing here, okay? So that's kind of it. You can also sell the contract back for a profit or for a loss, whatever the case is. But that's the idea behind buying options in this case. You can buy a call for it to go higher. You can buy a put for it to go lower. Now, somebody on After Hours brought the point and said, Fridge, what about the in the money aspect, right? Like, why would you buy in the money versus not in the money? And also about expiration dates and everything else. Is there a way of doing this, okay? Expiration dates can be your friend. The reason why they're your friend is because the longer time you have for these contracts, the more time you have of the option to work in your favor, okay? Like, for example, 1 day contracts aren't going to do much. You got to just hope to goodness gracious that it's going to hit 2% tomorrow, for example, for this contract to be worth money for you. You're hoping for a huge bump in 1 day. Think about it. 2% in 1 day, or if you go to December, for example, or maybe you want to go up, 7% in the end of the year to break even, right? Think about the logic there, right? You're either hoping for it to go up 2% in a day or in a week, or you're looking for a longer dated expiration where it has longer time for the market to move in your favor. You have almost a year for the market to move 7-8%. A lot better. So expiration dates for me, I like to think about looking at longer dates. It makes it a lot better in that case because it gives you more time for the option to be on your side. Now, besides that, we have in the money versus out of the money in this case. So 560 right here, this is what it's trading at right now. These are considered out of the money because obviously SPY isn't there yet. These are in the money because SPY is already above it. So these are in the money here. Now, what I want you to understand here with how in the money works is that, think about it, you're paying a higher price for it to be at least above this. So, for example, you want to go to the $500 strike price. For example, you're saying, Fridge, I'm going to hope and bet that SPY will close above $500 by the end of the year. So basically not come down $60. I'm sitting there saying, yeah, okay. Looking at the probability of that, it's very likely that's going to happen, right? That's going to $60 in less than a year. That's very unlikely to happen. Okay. So since you're betting for that to happen, I'm going to charge you more because it's very likely to happen. So that's why these premiums here are a lot higher, right? This is a higher premium here. But what this does is says, basically, remember, you are paying $85 for one share of SPY. And so what that means here is that your break even is going to be $585 because $500 strike price plus what you pay for the share gives you the break even price. But that means that SPY only has to move just a couple percent up and you're already making money here because you're past that break even point. So buying what's called in the money, buying these deeper in the money contracts gives you a higher probability of profit. You get less return, but it gives you more likely for profit on your side. Because again, if I wanted to go for a 490, for example, the break even is technically 583. That's not much of a movement. You're looking at about 5% movement in the next year almost here. That's definitely possible for that to happen. And the farther and farther down you go, the more you pay for the premium. So for example, if you want a pet that'll be above 400, it absolutely probably will be. But again, you're paying $173 per each one. It's going to cost you $17,000. But again, as the stock price goes up, you're making more and more money. But as it goes against you is where you're making that loss. So again, there is still a risk that SPY can go lower. Just $400? No. But again, your break even is 573. So if it closes below 573 at the end of December, you are taking a loss. But in the money gives you that probability because there's not as much movement that you are looking for here. And take a look at the options here. Delta to me is the probability of profit, or also how much this option will move. 97 means that you have a 97% chance of this expiring in the money, which is good. It is expiring above that in this case. Okay. What it also means is that for every dollar move in the SPY option or in the SPY contract, in the SPY share here, Delta's almost moving about $1. It's almost a 1-to-1 ratio here, which is good. You're getting that movement there as a result, right? If you want to look at this option here, say you want to go for a long call, you can take a look at C here. So let's type in the word SPY here, get the nice calculation here. So I want to buy a deep in the money contract here, which we can look at the $400 call option. Boom, right there. Here we go. Calculate. Come on. It's really doing some calculations here. I don't know if it's going to work. Come on, dude. What are we doing here? I got a video. I got people watching here. And I only have 30 minutes max here, I feel like. Looks like nothing's going to happen. Let me try one more time. If it doesn't work, then it doesn't work. We'll try another time. No big deal. Maybe we go to... No, I want to do that one, though. Because I want to make a point. And I love to make points. Here we go. So as you will see, again, the probability long-term is only 44%. So it's not likely that, again, you're going to make money in this case, but it is a high probability of you actually earning money as a result. And so what you'll notice as I'm changing these ones here is that, again, as SPY goes higher and higher and higher, you're in the green here. As it goes lower than the strike price, or as it goes lower and lower and lower, here's your break even. It goes lower, you're making a lot of money, or you're losing a lot of money here, as you'll see. Okay, so that's just one thing to keep in mind about with the in the money options. And for me, from what I've seen people do a lot of times is because they don't have the cash to pay for all this up front for a $17,000 contract. Like, why not just buy shares at that point? You can buy 100 shares in NVIDIA if you want to. A lot of people tend to trade Delta around like 70-ish is like the sweet spot. 60 to 70 Deltas is pretty good for people because, again, it's still a good movement you're looking for about a 6 to 7% movement here, but you're paying about a third of the price. So some people like to have a delta of 70 to 60, give or take, and how that one works. It's kind of up to what your preference is and what your risk is. And what you'll notice, again, if you buy a call way out saying, hell, fridge, it's going to go to $700. Yeah, buddy, you're paying $79 because the probability is very slim in this case here, right? You have to wait for it to pump up to $700. That'd be absolutely wild. So that's why, again, as you buy these calls, the delta is your probability of profit. It's also, if SPY moves $1, this contract goes up 3 cents. Yay. Not a lot of movement happening there. So that's kind of the ideas as to how buying options work. So hopefully that helps you out with the buying side of things, how people talk about it. Now, as for me, I'm someone who is on the selling side of options. So just like buying calls and buying puts, you can sell calls and sell puts instead. Now, this kind of ties into what the wheel strategy is here. And what you will actually notice with SPY, as you'll see my portfolio is doing awful because the markets are down here, is that I sell options, as you will see. So I'm selling some options here. This one, for example, I'm basically selling, and I'm basically, instead of buying a call option and saying, fridge, it's going to go to 575, I'm the seller saying, no, it's not. So the selling side of options is that you don't want the stock to go above 575, okay? And the thing is that this is called a covered call because, remember, you need 100 shares. If you're the seller, you need 100 shares when you're selling a covered call. You need 100 shares to give off to people if they want to exercise. That's why you need 100 shares, as you know. So I have 100 shares, as you will see. Not on here, but somewhere. It's there somewhere. Don't worry. I have 100 shares, guys. Don't worry. I promise. But so what you're basically doing here is that you're looking at this contract. You're saying, hey, I'm going to bet to you. You think it's going to go to 575? I think it won't. And I get paid a premium, as you will see, as a result. So when it says negative, that means I'm actually getting paid that amount of value here. And as long as SPY doesn't go up to 575, which right now it's down about 1%, this option becomes worth less, which means I capitalize on more premiums. So in this case, I'm capitalizing. I made $185 today because SPY is down. The option becomes less probable. There's less probability for it to happen. So the option becomes worth less, which means I collect more. That's the covered call side of things. I like to do it. And again, people say, well, what's a simple strategy to get into to start with options here, right? The simple strategy for me is selling options. And here's why. I sold 3 contracts of SOXL, which is a leveraged ETF that focuses on semiconductors, technology, chips, that kind of stuff, right? So I sold a put against it. Again, buying the put means you think it's going to go below 17. Selling the put means you don't think it goes below 17. But the difference is that you need to have cash available to buy the shares at $17. Okay, you need to have money available. It's called a cash secured put. So if SOXL goes to $17, I am forced to buy it from the guy who bought the contract. Now, as you will see, again, we do get premiums, as you will notice here, and there's a lot more math behind it, but you get a lot more premiums as you go. So again, this one's down $81. I'm up to $174 in this case, but you get premiums from it. So I'm making the bet saying it won't go below that. I'll pay this much money for this contract. We meet in the middle here. Okay, each contract right now is worth $310. Okay, so if SOXL doesn't go to $17, I collect what he paid me. He paid me out. He said, okay, here's $300. I bet it will do this. If it goes below $17, I still keep the premium here, but I have to own up to my side and buy 100 shares of SOXL at $17 each, which means I need $1,700 in what's called cash collateral. When you open these positions, the money goes into collateral. As you will notice here with my options here, options collateral. Right? So this money's put aside. I can't touch it. I can't do anything with it. This money's aside for if these options go against me for the puts, I will be forced to buy the shares. But as long as it doesn't, then once those options expire, this gets released. I collect the premiums and I get to do it again. It's called a cash secured put because you need to have the cash available to buy the puts or to buy the shares if it goes below the strike price. So the difference is, and then we'll wrap up here, cover calls, you sell that you don't want it to go above. So for example, I don't want SPY to go to 575. If it goes above 575, I'm forced to sell my shares at that strike price, but I still collect the premium. And that's why I say, well, Fridge, which one's the best strategy? For right now, for me, selling options is great because if I sell covered calls, oh no, SPY went up. I collect premium and I make capital gains on my shares. Cash secured puts, you're just getting it at a discount. SOXL right now is trading at $19. If it goes to 17, oh no, I got it for a $3 discount. And I get premium on top of it. So for me, selling options has been the way to really understand options and everything else, and that's why I've been doing it. So if you're looking to get started with it, hopefully this kind of helps you out. So thank you so much for watching today's video. I have to wrap it up here because it's a very long video. Again, hopefully you've learned a lot about buying options, selling options, buying calls, selling calls, whatever it is, looking at in the money versus out of the money, probabilities, profits, making money, all that kind of good stuff. If you made this part of the video, make sure you like the video, subscribe to the channel, and turn on your bell notifications as per usual. Leave any comments you have down below. I hope you guys are making money in the market as per usual, and I will see you guys in the next video.